Hey guys, I don't know if you're familiar with the Buffett indicator, but basically it's very simple. You take the total U.S. stock market value, which is $47.94 trillion, and they analyze GDP of the U.S., which is currently $27.04 trillion. And you just divide 47.94 trillion divided by 27.04 trillion and add a percentage to it, and you get 177%. So as you can see, even though the market's down 30% this year or so, give or take, at least I believe the market's down 30%. I don't in the past year or so, it's still way overvalued, in my opinion, the U.S. stock market, and that's why a lot of my investments are overseas, just because I know the U.S. stock market is overvalued. That's not to say you can't find value in the U.S. stock market, but it is very hard sometimes to do so. But this is from currentmarketvaluation.com/model/Buffett indicator .php, and you can go on and look at these charts if you want to. You can see how much the we're basically supposed to have a crash every 7 years, or at least a blip. But as you can see, back in 2000, the market value was only 13 trillion, and even 10 years later was even less. And then here in the next 10 years, it basically triples. From here to here, it triples. And then, anyway, you can see it. I mean, look at this. Just goes straight up. And you can see how far away we are from the norm. I mean, during the pandemic, we were really out of touch, like way up here. But and I think I forgot the guy's name, but he basically had said, around the world, the governments had basically dumped $40 trillion into the economies around the world, and in order for true equilibrium to be found, basically that $40 trillion around the world has to be destroyed. So we may not ever find a true equilibrium if governments around the world just continue to print money not backed by gold or not backed by anything, but just print money out of thin air. And as you know, there's diminishing returns anytime you overuse one of the three production factors: land, labor, and capital. And we are long past the point of diminishing returns, where every dollar the U.S. borrows and goes into debt, it only adds somewhere between 18 and 25 cents to the GDP, and you still have to pay interest on that. So it's never good for the government to go into debt. Now, the private sector is a little bit better about managing money than the government is. So the private sector can borrow $1 and turn it into more than $1, but when the U.S. government does it's always wasted. And anytime you see the U.S. government growing as compared to the private sector, it is not good for the U.S. economy. And with all these bonds available, a lot of the private sector is buying these government bonds. So again, you're pulling the good money, the private sector money, into the low returns of what the government does. And these are some criticisms of the Buffett indicator. When interest rates are high, bonds pay a high return to investors, which lowers demand and price of stocks. Additionally, higher interest rates means it's more expensive for businesses to borrow money, making it harder to borrow cash as a way to finance growth. Any business that takes on debt will face relatively higher interest payments and therefore fewer profits. Less corporate profits means lower corporate stock values. Lower interest rates means bonds pay less to investors, which lowers demand for them, which raises stock prices in relation to bonds. Low interest rates make it easy for corporations to borrow cash to finance growth. Corporate interest payments may be low, making profits higher. This is all to say that all else equal, if interest rates are high, stock prices go down. If interest rates are low, stock prices go up. And as you know, we have increased the interest rates, 10 times in the last year to try to get inflation under control. But what's going to happen is they're going to overshoot. And the Fed is not very good. They are reactionary. And when inflation was going hot, they did nothing. They waited for it to get to 20-25%, maybe even higher, before they started reacting to it. And, their target is 2%. And, unfortunately, this environment hurts the poor and middle class people. It really doesn't hurt the rich people who own financial assets. They own their own house. They own probably hundreds of thousands of dollars in stocks, if not millions or billions. In an inflationary environment, those financial assets go up, and then the people who don't own financial assets basically end up paying the bill, because their food prices go up, their housing prices go up, their gas prices go up, and they have less discretionary money to go and buy things with outside of just pure necessities: food, housing, and clothing. It says over the last 50 years, the interest rates on 10-year U.S. Treasury bonds have averaged 5.88% during the peak of the dot-com bubble. When the Buffett indicator was very high, the 10-year Treasury rate was a bit higher than average, around 6.5%. Today, the Buffett index is still quite high relative to a historical trend line, but interest rates are still relatively low, currently at 4%. I don't know how old this article is. It says update on August 31st. Well, interest rates I think are higher than 4%. To buy a house, I think it's around 7. You're paying around 7%. And also, it doesn't take into account international sales. Like it says, Amazon is in India and stuff like that. But anyway, there's an old saying, what goes up must come down. And, historically, in the long run, the U.S. economy and the U.S. stock market will continue to go up. But every time that the market should have crashed, we basically got bailed out by the government printing money out of thin air. And as you can see, from here to here, it's just gone straight up. If anyone was in the market back in either 90 or before, or even back in 2010, you're probably a very rich person right now. But for the new investors that are just starting out, it's very tough because we're at 177%. So we are very overvalued right now. Even though the market has come down 30%, we still could potentially have a long way to go. Now, you could say, well, if the market's going to go down, why don't you just hoard cash? And you could do that, and but if you hoarded cash right here, and then the market just kept going up, you'd have been holding cash for 13 years. So even though I know the market will collapse at some point, and has to. It can't just keep going exponentially up like this when the U.S. Economy is only at 27 trillion. So at some point it has to come back down to reality at some point. But I don't know when that's going to be. It could be next year. It could be in the next 6 months. It could be in the next 6 days. But I think putting your money to work and at least earning some interest and dollar cost averaging is better than doing absolutely nothing. Because, imagine if you were right here and you knew the market was overvalued and you just decided, hey, I'm just going to stop investing. Or right here, you said the same thing, and then, 8 turns into 50, 8 trillion turns into 50 trillion. You would have missed out on one of the biggest bull markets in history. And back when we were a farming economy, there was great innovations that allowed for more productivity, and then we went into manufacturing, and then we got more productivity, and now we're in services, and steel was great for the skyscrapers and stuff like that. I don't know what's next, and whatever's next could catapult our productivity exponentially. I mean, I don't know, in the next 20 years, everyone could have their own robot, maybe, and maybe the robot goes to work and gives you a check. Maybe the robot goes to work at McDonald's and works an 8-hour shift, and and then you get a check in the mail every week. Allowing the people to spend a lot of their free time thinking and reading and coming up with new inventions, or and increasing the productivity even further. But anyway, I just made this video just to caution people that the market is way overvalued, and just to be careful. It's always good to have a little extra cash on the sideline, so if things go down, you can take advantage of it. This is saying the long-term trend value is 121%, and so we're still way above trend value. Anyway, thank you.